Hello and welcome, loyal best ever listeners, as well as the best ever newbies. My name is Theo Hicks, and I am the host of the Best Real Estate Investing Advice Ever show, the world's longest running daily real estate investing podcast. And today I want to talk about how to calculate the value of your apartment. So the value of your apartment is based off of mainly two factors. Number one is the cap rate, and number two is the net operating income, commonly referred to as the NOI. Now the actual formula for value, which we'll call V, equals the NOI divided by the cap rate, which we'll say CR just for now. So value is the net operating income minus divided by, so the value is the net operating income divided by the market cap rate. Before we go into example, of course, we're going to go into more detail on what is NOI and what is the cap rate. So the cap rate, market cap rate, capitalization rate, it's referred to a lot of different things, is the rate of return based on the income that a property is expected to or indeed does generate. And the return is based off of an all cash offer. So the cap rate is going to be the cash flow divided by the property value, the purchase price, or however much money you paid to buy the property all cash. In order to find the cap rates, because obviously since it's included in the value formula, we need to know what the cap rate is, and we need to know what the net operating income is. To find cap rates, the best way are to, one, through recent sales of apartments, which you can find through various real estate brokers. Or number two, there's a lot of companies like CBRE who come out with quarterly, annual, biannual research reports that tell you a range of what the market cap rates are based off of whatever market you're in and the asset class you are investing in. So that covers number one, the cap rate. NOI, net operating income, is the revenue that is remaining at your property after paying all expenses. So it's calculated by subtracting the operating expenses from the gross income, from the effective gross income. So just for a quick example, if the income at the property is 100K, and the operating expenses are 47K, the NOI is $100,000 minus 47K, which is 53K. And then moving forward with our example, let's assume that you looked up the CBRE report and determined that the cap rate in your market for the asset class you're investing in is 5.5%. So based off of our value formula, in order to calculate the value of this particular property, we would take the net operating income and divide it by the cap rate. So 53K divided by 5.5%. Plug that into your calculator, and the property value is $854,000, 545. So that's the value of a property that has a net operating income of $53,000 and a cap rate of 5.5%. Now that we know how to calculate the value formula, we now also know how to increase the value of the property. Now, the cap rate is generally fixed. We could change markets. We could maybe try to push our property from a B class to an A class, a C class to a B class, and change that cap rate. But what we do have control over is the net operating income. So since the net operating income is based off of the the income of the property, and the operating expenses. If we want to increase our net operating income, we need to increase our income or decrease our expenses. If we increase our income and or decrease our expenses, then NOI goes up. And when NOI goes up, assuming the cap rate is fixed, the value of the property goes up, which means more money for you, more money for your investors. That concludes this whiteboard video where we talked about how to calculate the value of your apartment, which is based off of the cap rate and the net operating income. Thanks for watching. If you want more in-depth content on apartment syndications, make sure you check out apartmentsyndication.com. Thanks for listening, and I will talk to you soon.